During the bear market of 2023, I was doing like dollar cost averaging on Ethereum, buying ETH on Arbitrum. Now every day just go to 1 inch and buy a little bit. And one day, like 1 inch on Arbitrum, they just deprecated their DEX aggregator. So all of the trades on 1 inch on Arbitrum rose through their solver. And I was just very skeptical with the idea of having some solver, just supposed to find the best price. So I'm skeptical, and I wonder if I'm really getting the best price, or if it's better for me just to call like Uniswap directly. So I discussed the idea with Yuki, and Yuki was saying that we should write this as a complete research. So that's how we got started.
Hello, everyone, and welcome to Index Podcast, where we come together every couple of weeks to discuss on-chain data, chart crimes, and metrics that move the crypto industry. Today, I'm joined by three people. First of all, my co-host Danning, on-chain corgi at Flashbots.
Hi.
Yuki, defender of LPs at Sorella Labs.
Hey.
And Dex, financial artist at Semantic Layer.
Hello, everybody.
As well as myself, Hill Dobby, resident data house elf at Dragonfly. So before we start, I just want to say that nothing we say here should be relied upon as legal, financial, investment, tax, or even life advice. We're acting independently of our respective professional roles. Today, we're joined with these three people to discuss a paper you recently published called Execution Welfare Across Solver-Based DEXes. Before we dive into it, could you guys introduce yourself a little bit? Danning, we've heard you in the past, but maybe Yuki, you can go first.
So hey, I'm Yuki, and I'm currently spearheading a lot of the research work and some of the growth integration works at Sorella Labs. Maybe a little bit about Sorella. We're basically trying to build a V4 based DEX protocol, and hence why I'm working on some research related to this execution welfare paper that I've released in collaboration with Danny and Dex recently. And yeah, so that's about myself. Yeah.
Awesome. Dex, what about you?
Hi, everybody. My name is Dex. Previously, I was doing smart contract audit, and right now I'm one of the co-founders and also product designer at Semantic Layer. And Semantic Layer is a transaction sequencing layer for dApps. And right now I'm working on building some AI-related dApps to bootstrap the initial order flow on Semantic Layer.
I wanted to share a little bit how I met Yuki and Dex and on this mission of this paper. I mean, I met Yuki before when he was still like head of research at Fimbush Capital, and where he was hosting a lot of this research meetup around the conferences, and like he was pretty deep into MEV and PBS. I think I just joined the Flashbots when he was presenting some of the PBS stuff, and yeah, that's where I met him for the first time. And Dex, I met him in one of the SBC conference, and he was at one of the Flashbots hacker house, and he came up, he was like, "Hi, my name is Dex." I was like, "Oh, Dex, just like the Dex," you know? So it's a kind of like a destiny set to be happening that he's researching on Dex. But yeah, so when I heard about this paper, they already actually have like 60-80% done. So I kind of joined later in the progress when they started applying for the TLDR fellowship, which is a DeFi research initiative, kind of a research council. There's like basically started by Tarun and Raphael. Was the first 2 years of grants coming from Uniswap Foundation to encourage more, DeFi research to be more formal and better quality, to become like academic level. I think there was like a little bit of jaded past from Tarun, where he always say that like when he started doing DeFi research, he was writing papers about DeFi and people just never take it seriously. And so he really want to encourage to bridge the gap between academia side and DeFi research, where, you see most of us always posting just on Twitter, like a lowercase r researcher. But now we're really proud. Now we can write all about like Uniswap and CowSwap and 1inch Fusion and all these things into these kind of paper. So yeah, that's how I basically got involved into this paper.
Very cool. So if you joined later, Yuki and Dex, what motivated this research in the first place?
Yeah. So Yuki and I, we know each other for almost 4 years now. So yeah, during the bear market of 2023, I was doing like dollar cost averaging on Ethereum, buying ETH on arbitrage. Now every day just go to 1 inch and buy a little bit. And one day, like 1 inch on arbitrage, they just deprecated their DEX aggregator. So all of the trades on 1 inch on arbitrage rose through their solver. And I was just very skeptical with the idea of having some solver, just supposed to find the best price. So I'm skeptical, and I wonder if I'm really getting the best price, or if it's better for me just to call like US directly. So I discussed the idea with Yuki, and Yuki was saying that we should write this as a complete research. So that's how we got started.
Yeah, and then I guess to also add a bit of color, I think there were times where we were discussing about like, oh, which aggregator platform do we use? Like, do we use CalSwap? Do we use 1inch? And I remember Dex also co-founder Daniel. He oftentimes was saying like, oh, how he like always use CalSwap and not like 1inch. For from his experience, somehow CalSwap is better. Somehow, like we never know like how much, but like somehow it's better. So we're like, they were like, okay, so somehow CalSwap is better, but like, is it though? Is it actually better? And so I think there were a lot of questions looming around, like, are those trading venues that we always use day to day like seems better, but like we don't know exactly whether it's better or not. So I think that question came up, and then with Dex, I was as we were discussing, I was like, maybe let's just make it into a proper research projects, and that's kind of like how it started initially. And honestly, like when it began, it was mostly just a sort of like projects that we were just kind of working on the side and see how it goes and running some simulation and see the results. But yeah, like I think we saw the results, we didn't think that it would transform into like a proper paper like it is today. So I think Danny came in to really help shape that into the paper that we see today on Archive, and I think she also played a critical role in that as well.
My initiative or my motivation is basically I've worked in 0x for like 3 years before I joined Flashbots, and it's such a tough battle for any of the DEX aggregator in this space to how to say position and market yourself. I think in general, overall, like CowSwap has always had this kind of impression on people that like because of the design, it's an aggregator of aggregator, so supposedly the price will be better. And so there's like a whole basically playbook of narrative in the DEX space where you say, okay, AMM liquidity DEX is basically it's good for liquidity provision, but it's not necessarily going to be the best price. Once you add a layer of aggregator on top of it, you'll be able to basically aggregate it for the better pricing across different liquidity pools. Okay, but then now you have meta aggregator supposedly going to basically be better than aggregator, but also sometimes the aggregator may add a layer of fee at the middleman. So like, and then on top of that, there is like solver-based DEX design, which, as I understand, CowSwap started it. And the initiative or the goal is basically saying, hey, we are doing this aggregation, but what if we make it even more competitive, say outsourcing this job to a set of people and let them compete? Is it better or not? And in the past, there's been some paper discussing it. For example, there's one called intent-based market analysis from Tarun and Malish and a few others. They had an interesting point saying actually, if in the market there's a lot of assumption of holding inventory as a solver, which means it's a likely focusing on more of like the RFQ type of solver, meaning basically the person who is a market maker and they hold assets on centralized exchange, they're hedging to make profits. In this case of like setup, the competition actually will have a lot of entry barrier because you have to have a cost on holding inventory with risks. And so that is actually going to lead to some monopoly or even like the one person dominating kind of result. So that was an interesting preliminary literature review we've seen only. And so yeah, we started to look into all these three solver-based DEX aggregators to see who is really better. Yeah, to answer a question I've always had is like, okay, CowSwap says they're better and people say they're better. Are they actually better? Yeah.
So to summarize, if I understood correctly, the goal here is we've had originally automated market makers, which is essentially automated pools, and then there's solver-based models that later popped up, mainly starting with CowSwap, and later followed by 1inch with Fusion, as well as I forgot the other name.
Uniswap X.
Sorry, yeah,
X,
Uniswap X.
Yeah.
And your goal is to try to assess which is better. Like you said, a lot of people have claimed to have better experience with solver-based model, but it's been hard to quantify. So your goal here is to quantify that difference.
That's right.
You guys came up with a new metric that you called execution welfare. Could you define that metric? What is it? What does it represent? And why did you choose that metric?
One thing to mention to clarify is that like there's many ways to measure if a DEX is good or not, but our goal in the end of the day is to measure if it's good for the end user. So meaning like the trader that is accessing it in the front end. And yeah, Yuki can explain further.
Yeah, so execution welfare is actually a pretty simple metrics that we use here. And this is like specific in the context of like comparing executions on chain and in the context of like AMM output. So essentially, we have execution welfare equals to solver output minus the AMM output after gas. So both would be accounted for gas divided by the same denominator AMM output after gas. Which this would essentially shows you the sort of like the percentage delta. You can think of it as like a bips, basically, like the bips difference between like the actual output from the solver and actual output counterfactual output from the AMMs. And that way we can say like, if this trade was executed by a solver, we get X amount. If this trade was executed instead by AMM, we get a Y amount. And what is the diff between X and Y? And then we try to calculate that in the forms of like essentially a ratio, which you can think of as like a sort of like a bips. Yeah.
Okay, so from that formula, you need a specific execution for solver and AMM. My guess is that this means you could only simulate all the trades, or were you able to look at past trading data? How did you look through the data, and what data do you use to plug into this formula?
Yeah. Dex, do you want to go
Yeah.
through some methodology part? Yeah.
Yeah, so the solver output amount, those are actual trades that are filled and already happened. So we basically took the 1inch Uniswap X and CallSwap settlement contract and queried for the past settlement data on two assets, two trading pairs. Like one is ETH versus USDC, and another one is PEPE versus USDC. And
PEPE versus ETH.
Yeah, PEPE versus ETH. So those are the trades that actually happen. And then for each of the trades, each of the solver field trade, we have the block number. We know when it happened, and then we'll go back to that block and query for the pool status of the corresponding pool, like whereas USDC pool and PEPE ETH pool on Uniswap V2 and V3. And then we use the top of the block to situation to simulate if this trade is facilitated, is executed by those MMs, how much output the user will receive.
Yeah. And then one thing that we also just want to add there is that with both of the simulations, one very important aspects that we had to consider, which actually made a significant difference to the data, was how we calculate, how we estimate the gas. Because we can estimate the gas with, let's say, the median gas price, or the highest gas price per block, or even the lowest gas price per block. And we did some simulation on both scenarios, and we realized that based on the different gas price that we picked, like for example, you see like the red is we picked the max gas price, and then the blue is like the minimum gas price, and then we also saw like what is the realistic gas price and the solver gas price. So you can kind of see the color. The solver is orange, realistic is the green, and then the extreme is the red. Based on these gas price, we also notice there's a significant difference in the execution output based on how much gas is being charged by those simulated results. So we had to ensure that we picked also the right approach, and this is kind of like where we figured out, okay, like, we could go with the optimistic approach. We could also go with the more conservative priority fee adjusted approach. And then we ended up actually going for the latter just to be more conservative in our simulations. But yeah, the gas part was specifically like more challenging to nail down because that changed the results a lot. Yeah.
Yeah. Just to add a little bit context on that, if you look at the execution warfare formula, you see that like for solver output amount, we're just taking the output amount, but AMM output amount, we need to account the gas that user needs to pay. This is because in the solver model DEX, when you basically send a transaction on CowSwap, you don't really need to pay gas fee because they will settle the transaction for you. The interface is using some permit to meta transaction type where user is really just like signing, say, approval of spending my assets on my wallet, and you're not really like actually submitted a transaction, but instead the solver actually, their operator going to submit a transaction using the liquid inventory on your account. And so that's why when we compare that with the actual net output the user can get, we will need to still assume a gas in the AMN simulation to make it equal.
Okay. What do you find?
Yeah, so I think well, I guess so we'll get into some results here. Yeah, so I think let's just start with maybe this plot first. So first, I to kind of give a higher level overview on what was the overall results. We plotted this box plot for the welfare, where with the box plot, essentially the upper bound is like the 75th quartile, the lower bound is the 25th quartile. The middle line that you see is like the median line, basically. And then for each pair of token, the PEPE width and USDC width, I have the CowSwap, 1inch Fusion, and Uniswap X from the left. And as you can see from the results, I think the Uniswap X, at least on, let's start with the USDC width side. Uniswap X seemed to show probably the largest variance slash spread of distributions of trades in this like three metrics that we measured versus CowSwap and 1inch Fusion. And in general, CowSwap seems to have done a slightly better job than Uniswap X and maybe close to 1inch Fusions in the actual execution. So yeah, overall, like just from looking at this, like we can see that like CowSwap and 1inch is generally a little bit better in actually executing against Uniswap X. And then we move to the other part, which is the PEPE width. So we picked this assets as to kind of show the difference between the long tail and short tail assets behavior. And I believe that PEPE was a pretty good candidate of the short tail, even though it's not like that short tail, but it's short tail enough that it has much less volume than USDC width, but it has enough volume to be still executed via an aggregator platform like CowSwap and 1inch Fusion and Uniswap X. If it is too short tail, you don't even see them on those aggregator platform essentially, right? So so if you look at that results with this V2 and V3 execution warfare on the right here, you'll notice that actually the results are somehow a little bit better on the Uniswap X side, and now the CowSwap and the 1inch doesn't have as much advantage in that regard. Yeah. So and also in general, like there's a lot sort of like a less how should I say, like if you look at the y-axis, the execution warfare bips, like the bips amount is like much bigger than the bips
Yeah.
amount here. Like it's like up to 50, negative 50, and this is like up to like 2000. So yeah, like there's a significant spread of execution warfare on the PEPE versus a short tail assets like USDC that we uncovered as well. Yeah.
Right. Yeah,
Okay.
and I think compare across these two asset pair, it's kind of saying basically it's non-conclusive to say which platform is better overall always. I think like it depends highly on like what's the asset type and like basically whatever the solver's liquidity or they are good at across different platform. But also one other thing to caveat here is that if you read into those BIPs numbers, so for example for the USDC one, when comparing with V2 V3, it's overall how to say for V2 comparison, all of the platform are generally net positive. So meaning the solver execution that we collected did have a improvement for the compared to the simulation we had for V2. But this is not so surprising, right? Because like USDC liquidity are mostly on V3. So
Yeah.
it's definitely has its like limitation in terms of a benchmarking if you want to read deep into it. So our suggestion or how the way we interpreted all these results is not to like really read into like what's the number that compared to the benchmark. It really just trying to bring a C level for different platform, right? So then you can compare across platform if that makes sense.
Yeah, and then I think I'll also kind of like dive into that, like the V2 V3 difference here. But I just want to note here that in general, like aggregator platform like solver platform generally do better than V2 in a short tail assets, but in a long tail assets, uh, that may not be the case, because as you can see here that the V2 is doing better than V3. It's counterfactual trades. So basically, yeah, the solver platform is actually somehow doing just as good as V2 on those long tail assets versus those V3 counterfactual trades. So there's like a kind of like an opposite results that we see here with versus short tail and long tail, basically. Yeah.
Which is also because the liquidity distribution, right? I think there we will need to do a more, I would say, thorough correlation analysis. But if you look at the liquidity distribution, the PEPE, how to say, the PEPE assets on V2 across the data range we covered, around it was around 10 million, and on V3 it was around only 5 million and dropped to 2 million. And so it's like the results or comparison isn't too surprising because whenever the liquidity depth is thicker, it's probably giving you a better execution. And that's why we see on V2 measures, the long tail assets is like harder to have a more improvement for the solver compared to V2.
But so why has liquidity for long tail pairs such as Pepe stuck mostly to V2 then? What do you know the reasoning for this? Is this like because there are less sophisticated market makers, or I don't know? Could
I
you
mean,
have an explanation?
I mean, like it's being a pattern where like most of the meme coins just gonna launch on V2 easily, and
Yeah.
also attract liquidity where like to attract also naive liquidity where you don't need to like manage your position all the time like
Yeah.
V3. It's
Yeah.
also probably it's not covered in the PEPE data set, but like pump.fun or like similar meme coin launchpad, they will basically move the liquidity to V2 instantly once the tokens liquidity move up, like trading volume or TVL move up to a few hundred million. So
Yeah, yeah, and also because like assets are so volatile with those with those long tail tokens, that actively managing that position would be probably like a nightmare to
That's
do
true.
as well. Yeah, so I think V2 would be definitely just easier for them to kind of deploy and kind of leave it. And sometimes they even burn the LP token for those meme coin as well. So it's like, okay, we'll just provide a full range liquidity, and then they forget about the LP tokens, or like they just lock the LP token on something. So
Okay.
yeah.
In your USDC wrap teeth graph, you also include Binance markouts as I'm
Yeah.
guessing some kind of like control, which remains in each E3 cases, CowSwap One Infusion and Uniswap X, the better execution price. do you know why that is, and do you see any path to that changing and like better execution moving on chain rather than like onto centralized exchanges?
Yeah, so I think one caveat I would say is that so we did calculate the Binance markup price according to this formula, which is actually like similar
Yeah.
to like the execution warfare formula as well,
Hmm.
except that it's actually comparing with Binance on off-chain price. Now, this Binance markup price, the price that we picked was the mid price, which is essentially the mid between the best ask and bid on the Binance order
Yeah.
book, right? So we picked the mid price and we used the mid price as the benchmark for comparison in the case of with USDC. So that was probably a slight caveat, because if we actually picked the best bid and ask for corresponding comparison, then we probably would have gotten a slightly different results. Having said that, I think the general notion of Binance Markout showing that Binance is better than CowSwap, 1inch Fusion, and Uniswap X is actually, in my opinion, not that far off, because even if we pick the Binance mid price, the spread of best bid and ask on Binance isn't as big as like 50 bips, for example. Like that spread is tight enough that from the results that we see, it's pretty clear that let's say the cow swap is oftentimes executing somewhat worse than Binance by a range of 0 bips to more than negative 50 bips, right? So in that case, this is kind of to show that yes, there is some fairly significant size of trades on CowSwap that are actually worse than Binance, even
Hmm.
accounting for the best bid and ask spread on the order book. So I think yeah, the general notion that yeah, Binance is better than CowSwap and 1inch Fusion and Uniswap X is probably true according to this data that we have. To the question of you asked like whether we can close that gap, right? Like in terms of making that green bar
Yeah.
go even higher, essentially. Um, I think that one is gonna be quite tricky, because realistically, right now, like all of our all of the on-chain trades are somehow suffering from some sort of like stale price, even to some extent, and that most of the price discovery is still happening off chain. And as long as
Yeah.
that is the case, unless we have like Wintermute or GSR or whatever those like big market makers to actually market make those AMM liquidity, which they aren't like doing so today unless they're getting paid, then it becomes very difficult for such off-chain price to reflect that on-chain like in real time at with the existing market structure and the AMM design that we have today. Yeah.
I would
And
argue back a little bit on that, which
Hmm.
is I think a lot of those market makers you mentioned are actively participating in like RFQ quoting, like say basically
Yeah.
providing liquidity across the users, and they are and others are also actively arbitraging the stale price. The fundamental issue, in my opinion, is like the block time.
yeah.
This block time is 12 seconds, and for sure there
Yeah.
will be a discrepancy of the price compared to a off-chain order book that's like
Mm.
milliseconds. So
Mm.
it's by design somehow, I think.
That's right.
But
Yeah.
we should also look at the charts that's controlled over trade sites, because that also kind of showed an interesting pattern. If Yuki wanna explain.
Yeah, sure. So this data is to show like, oh, if we increase the trade sizes, how does the execution welfare correspondingly change for Cal, 1inch, and Uniswap, essentially? And we looked at for both the PEPE and USDC data as well. And then let's start with the USDC data. I think this one is kind of like pretty consistent and clear that like with the larger trade sizes, the V2 like those solver based DEXs clearly outperform V2, and you can see sort of like a candlestick type of things, right? With the blue dots kind of like sticking up. So that is an indication that, yeah, like with the larger trades, you should be executing on Cal or 1inch or Uniswap X. And given that how Cal has quite a bit more volume, like that stick is a little bit more significant on the CalSwap venue versus others. But yeah, roughly the behavior were the same. And then with the orange color, orange is the V3 execution comparison. So we noticed that comparing against V3 with larger trade sizes, it wasn't always the case that with all the platforms that you get a better execution with the bigger trades compared to V3. So let's say like 1inch and Uniswap X. Let me just like kind of zoom in a little bit. So
Yeah, that's better.
yeah, I hope this is a bit clear. So with 1inch and Uniswap X, we actually didn't like observe like a as significant uptick on the increased execution warfare on those solver based DEXes. Although it's still like slightly positive, like this little bips that you see is probably like a few bips of advantage that the 1inch or Uniswap X have over the native V3 execution. So there's still advantage, but it wasn't as significant. And especially when compared to CalSwap, where we did observe a somewhat significant uptick of this part, where you can see that with the larger trades that actually, yeah, like CalSwap did give out some significant execution advantage against the V3 counterparts. And then, so that was the second observation. And then the last observation was just like, okay, well, we kind of expected that, yeah, Binance markup would be always somewhat negative. And to our expectation, it was also true that, yeah, most of the Binance mid price at that specific time when the trades happened is like somewhat negative or like slightly negative ish. Like this is probably around the range of like negative 1 bips to like negative 5 to 10 bips ish. So that's like what you basically see here. But it's like somewhat more consistent in that it is always like slightly negative. So that was the observation. And with the increasing trade size, I don't particularly see like sure, like the variance of the green dots would converge and decrease, but it's again like it stabilizes at some point where it's like just slightly under zero basically. Yeah.
If with all this paper you've worked on, which front end do you guys would you guys now go to or recommend going to, based on different users, whether it's like large trader whales or the small fish who wants to trade $10 worth of tokens or whatever? What would you recommend for whom?
I mean, I obviously this would be somewhat, I guess everyone may have their choice there, but personally, if I'm trading like a large amount on chain with a short tail tokens like WETH USDC, then I probably would be going to CalSwap. Yeah,
Okay.
realistically, yeah, like that's an unpaid show, by the way, but yeah, so that's there.
Yeah, I mean, for me, the serious answer is just that we can look at which one gives like subsidies to solvers, so that kind of reflects in the execution result. The answer is answer is that I go to call swap just for the move. Like every time you swap, the call will move.
Yeah. That's the better execution.
Yeah, that automatically makes me feel like I'm receiving better result.
Yeah, but for the trade size that we looked at, I mean, it's still not as large as something like like hundreds of millions of ETH or even like tens of millions of ETH. So realistically, if we were to recommend anyone who's doing a significant size, to be honest, it's still pretty hard for them to do it fully on chain. Like I think realistically, with the AMM liquidity infrastructure that we have today, I don't I don't even know if Casop should be handling like millions of dollars of order from large whales. Like realistically, they should probably just go to Binance, or even use some OTC desk or some sorts. Yeah.
Okay. Okay.
Mm.
Another question is, I recently saw that, and let me know if that's wrong. I think PEPE is one of the tokens with the largest on-chain liquidity on Ethereum mainnet, alongside tokens like Link and Uni. You mentioned it being long tail. Do you mean long tail in terms of volume, or long tail in terms of usage on solver based model? How do you define long tail here?
Oh, actually, yeah. So the way that I looked at the way that we kind of looked at long tail was actually based on volume. So
Okay.
so when I picked Pepe, I basically ranked the top whatever 50 top 50 V2 V3 pools by volume, like historically.
Mm-hmm.
And
Mm-hmm.
then I went through from the top to bottom. And then basically, like, obviously there were like in the top 20, there were like, Link and Uni and some of those names that you mentioned. But towards the bottom, like top maybe like 25, you will start to see like Pepe and those like other meme coins that are like it's not that long tail, but still like relatively long tail compared to all of the volume that ETH,
Yeah.
USDC, and ran out those. So I kind of picked those like later half of that rank as what I consider as a more longer tail assets, basically. Yeah.
Okay.
Yeah.
Very
Yeah.
good. Okay, makes sense.
Yeah. And I guess just to kind of show the other half, which is the Pepe part, as you mentioned. So we know that Pepe have expressed like a very different behavior than the short tail USDC with
Mm-hmm.
trade execution, and as you can see here, that the graph is also quite different. So with regard to Pepe, the orange here is the V3 execution warfare, and then the blue is the V2, and you can see that let's say to be honest, for both Cal 1 and Uniswap X, like you can kind of see that those solver based DEXes against V2 execution, like you still have this like a slight uptick that you can observe from this previous graph. So with the
Yeah.
larger trade size, it's still somewhat more competitive because, as you know, like with V2, the slippage would increase like a candlestick as the trade size increases. So there is some advantage. However, against V3, you kind of see like a behavior where the advantage of V3 kind of like diminishes as the trade size increases, and this is like probably the most obvious in the case of Uniswap X, where with the trade size increase, and then the execution wafer just like kind of decrease from all the way to close to zero. Obviously, like this, there's still a bit of like a space at the end, but like basically the general pattern was what was that. Yeah.
This has also me interested in, I think, my intuition would be that tokens such as USDC, wrapped ETH are traded differently, or at least by different people, than meme coins such as Pepe. And I think there could be an interesting research on how those different trader profiles are on, let's call them like tokens with intrinsic values versus meme coins. And yeah, I'd be interested in looking on this, and how you know your average trade looks for both tokens, because I think that also goes in line with the differences that you see in long term versus short tail categorization of these two assets.
Yeah, for sure, definitely. And I think Danny also later on have the parts where we look into the liquidity profile as well. So that I think that part might be of interest.
Right.
Yeah.
So yeah, right here we also trying to understand why the execution is better or not. it's hard to really draw a conclusion without a correlation analysis, but we did find out like some distribution thing that are interesting, which is like one thing when you analyze across these platforms is to acknowledge that their liquidity breakdown are different. Like meaning, even though CowSwap, Onchain, Uniswap X, they may have a overlap list of solvers that are basically solving across multiple platforms. Their overall solver profile are different. So the first chart on the left shows that for CowSwap, over 85% of the volume are settled against AMM liquidity, meaning most of the solver on CowSwap are basically running a algorithm against checking different like liquidity pool, what's the best way to route and split it up the order to provide a better price. But compared to Uniswap X, it's pretty much more of a RFQ, how to say, platform where you can see that over 80% of volume are filled in by PMM, which is private market maker or private like professional market maker, where they have like a few 100 million assets held in their wallets, and they are going to basically provide a OTC order against you and trying to match your order. Potentially, they are making money elsewhere on SEX to basically hedge out the order that they basically settled on chain. So you would basically find out that also in terms of the asset type or asset pair, if we categorize the token type into long tail and pegged asset, meaning like it's basically ETH to STETH or ETH to some other type of wrapped ETH, meaning there is not supposedly not much price discovery. They should be pegged at the same value. Another type is as blue chip, meaning somewhat major coins, but not Ethereum or Bitcoin. So for example, like Uni token or like some other major DeFi tokens, which has enough amount of liquidity, but not the USDC. And then ETH BTC pair, which means basically ETH and BTC against the stable coins. Yeah, pegged also include the stable to stable here. You can also see an interesting trend where as the token asset pair goes more major, there's more PMM participating in the liquidity settling on chain. So it's definitely a trend, and or I would say it's like a kind of framework to think about, which is like basically the more major or more liquidity and volume there are for these assets, the less risk to hold inventory for, and so it's more likely market makers will be willing to provide liquidity and also compete in the solver competition. I think intuitively in the past, what I learned is that like whenever there's private market makers come in, they supposedly is helping to bring the price execution to a better level. So we have a breakdown as with two other charts below here, which is trying to see like is the execution welfare really, matches the trend matches with the liquidity profile trend. We see here that on the chart on the left is that overall across the three solver platforms, when the trade size goes up higher for USDC pair, there's actually more and more AM liquidity being filled once it go up above the basically the 10 how to say 1,000, 10,000 trade sites, 10,000 USD. On the opposite, PEPE actually, once your trade size goes up to 1,000, it's being filled more and more by the private market makers' liquidity, which is quite interesting. It's a bit counterintuitive to what I would assume. Yeah, and apparently this could be biased across different data samples from the three platforms. Like say, if one of them has more volume on this pair filled by the private market makers, then it might, distort the result. So we try to break it down on the right side to per platform and per pair. And so we basically observe that, yeah, the overall trend is similar to what we saw earlier, where CowSwaps, both long tail and short tail pairs have over 80% of volume being filled by AMM. 1inch has a lower level than that, but in the middle. But then Uniswap has like basically, less than 20% of volume for both pair are being filled by AMM. So mostly are PMM. So that's quite interesting as well.
Is there any comparison on like how much liquidity do those private market makers or professional market makers have that could, help understand those differences?
Right. I think not really. There's no data set you can look at and say, oh, this is this asset, and AMM TVL is this, and PMM TVL is this. I think PMM analysis are generally like still stay in the shadow, like because market makers wouldn't like to be tagged all the time, and they also have probably. I mean, they also have security concern of potentially being exploited by North Korea. I don't know, and so I think overall, PMM or market making or RFQ analysis are still like to be developed.
And also, like I mean, most of the PMM these days are also operating on prop capital as well. So like knowing their TVOs to some extent, also knowing like what's on their balance sheet, which may be a little bit hard to discern. So
Yeah, and I think like it basically all these like profile breakdown doesn't really give us a conclusive result saying like PMM will always become better in terms of like execution, providing execution. It really highly depend on different platform, like what's the what's the market maker there, and like what do they prefer and what asset do they hold. But one thing I think like is interesting is like fits the overall results is that if we scroll up to like the beginning part in page 5, we have a Dune charts that is basically just describing what's the current market structure look like across different platforms. We do see that there is a, like if you look at the latest few month data and look at the colors, you can see that the first one is Uniswap X, second one is the one inch fusion, third one is CowSwap. CowSwap does show a more diverse profile of solver market share. So basically, CowSwap's top one solver is Wintermute, which is a market maker that is also dominant on 2 other platforms. But if you follow down the top 5 list, the next 4 solvers, they're all taking up around like 10% market share. So it's a fairly decentralized. And for one inch fusion, it's slightly worse or like a little bit more concentrated, where there's 2 top market makers that is dominating over 80%. And then if you look at the Uniswap X1, it's becoming like basically SCP and Wintermute, which is 2 market makers dominating over 90%. So, the one inch fusion was like 3 solver dominating 80%. So I think this somewhat definitely correlates with the trend where we see that CowSwap does show a bigger uptick on the major assets of better execution.
And I think this is also to show like CowSwap may potentially have a better competitions on actual like quoting the price when fitting the orders versus Uniswap X, where there's only like 2 dominant players. If they both collude somehow, then they can always better like always offer like worse price just to fill the orders, for example. Yeah. And then the last bit is to kind of like just get some overview on the volatility, which Dex, maybe you want to also go over as well.
Yeah. So for volatility, we use a metric called realized volatility, which is also used in other traditional finance research paper. And the short answer is that there seems no correlation between the volatility and the execution welfare. Seems that the execution welfare is just consistent, like no matter what the market condition is, which is surprising because we initially assumed that when the market is more volatile, maybe solver DEXes will have a better execution welfare because solvers, they can adjust pricing on the fly versus AMM are just like just sit there. But yeah, the end result we get is that there's actually no correlation between those two.
Yeah. So yeah, basically, regardless of the volatility of the market, I guess the CowSwap or those solver-based DEXs just execute as usual, and there wasn't a significant correlation. Yeah. So here's the conclusion. We're not here necessarily to say like which solver-based DEXs are necessarily better, but we just wanted to provide a framework for people to understand and study how those solver-based DEXs behave differently from those V2 and V3 counterparts, and how some of those may have a different solver and liquidity profile versus others that may result in those kind of results that we have observed from this study, from this paper today. And also especially the difference between the long tail assets and the short tail assets behavior between PEPE and USDC with, and how they differ in also in terms of those execution warfare, and especially in light of those solver-based DEXes, how those solver-based DEXes deal with it. And after hopefully people reading this paper, they can realize that actually, if they're only trading like a small amount of like PEPE, they might be just easy, just go on whatever AMM on V2 Uniswap, and they can just get the similar results as a solver-based DEXes. And versus if you're executing like a larger trade size, most of the time you're better off going to the solver-based DEXes than not, for example. So yeah, but yeah, there are definitely a lot more involved here. So, but I won't go through every single details. But that is sort of like the idea, and definitely welcome anyone who is interested to dig into this paper and share some thoughts later on as well.
What are you guys, using from this paper to work on your respective projects, or is there anything else you want to mention about your respective projects?
Sure.
Sorella and Semantic, to see how we can further improve like market makers on chain and DEXes essentially.
Actually, to answer your point about like how we can improve and what are we looking ahead from this research, I think there are a few points that I wanted to point out that we weren't able to cover specifically in this study. This is kind of mentioned on this limitation part. One is the selection bias. So a lot of the time, the solver, there are like auctions that solver may perform, like with Uniswap X or 1inch. As with CowSwap, there's like some delay to when the order comes into the platform versus when the filler actually fill the trades and execute it. And oftentimes those data on when the order comes in is not quite available publicly. So from our perspective, we cannot tell like when this order actually comes in. We can only see when the order gets executed on chain. So there is a bit of a delay and also a selection bias in terms of like what order actually gets executed. Like there could be a scenario where like what we are seeing executed on chain is actually just maybe like 80% of the all of the trades that are going to those solver based DEXes, and 20% are actually maybe not getting filled at all. Maybe they're just like left hanging there, especially in the case of like 1inch and CowSwap, where they don't have necessarily like a backdrop option of just going straight to AMM routers. They simply may not get filled. And in that case, those trades, we don't see it. So that we simply cannot accommodate in our framework of execution warfare. But in fact, those trades are potentially oftentimes are the trades where it could make a pretty significant difference statistically on what kind of trades that fillers, solvers are not willing to take to fill those orders. But we don't see that. So I think that's a bit of a tricky aspect that we cannot consider. Another aspect is the time, because we don't know when the order comes in. We also don't know like how long exactly it took for the order to receive the fills and then eventually get executed. Like there could be always a scenario where the order comes in, the solver fillers wait for like a 12, 24 seconds, and then if the price in the market moves in favor of the solvers, or vice versa, they may decide or not to fill the trades, and there can be some conditional aspect to filling of those orders and so forth. So there's always that aspects that we couldn't account for, and then another aspect that we didn't account for is this solver reward incentives. So I think this is actually, like, in my opinion, probably like one significant aspect of this like whole research that we couldn't really take into account, which is how much rewards are giving out to the solvers from the CowSwap platform with the Cow token and a 1inch Fusion platform with a 1inch token. because namely those platforms give out those rewards to basically obviously get those solver involved in the platform, like to incentivize their involvement, but also as some of them have written on their article, like they give out to kind of offset their gas and solving costs. So what that essentially means is that like those platform when users go to trade, they don't have to pay tax to some extent because the tax and maybe even the surplus of that is being subsidized by the platform token, which means that you could actually be getting a better execution, and because those token incentive that is going out to those respective platform, but like including Cow and 1inch. As of right now, I don't believe that Uniswap have that kind of incentive, but like so far, I believe CowSwap and 1inch have done such incentive scheme. Obviously,
Yeah.
like this stuff always change every quarter, so no guarantee. But yeah, that's another aspect that we couldn't really take into account. Yeah.
Yeah, want to double tap on one thing Yuki mentioned here, which is like the batch auction delay thing, which was a one critique that we received on Twitter when we like kind of like hinted about the research, because we are comparing a simulation that's on the last block, the previous block's end, or how to say, like on the top of this current block of the solver. We're only measuring how do they perform compared to the latest liquidity distribution, instead of like actually measuring how user can perceive basically the quality compared to the time they request it, right? So if I put a order on CowSwap 3 years ago, say I want to buy ETH at this price, they got filled 3 years later, I may not be happy with it. And at this point, we're comparing, say, okay, they filled with a pretty recent price of this block, and it looked pretty good compared to the block before, but like what, like if the user could have gotten the price before, it might be, well, although ETH is no difference, which is a sad thing to say here, but like let's say Bitcoin, like 3 years ago the user wanted to fill the Bitcoin, and 3 years after, it will, they filled you with your order and looked a good price compared to the block before, but it's not good for the user. So whatever we measure here still doesn't reflect what exactly the user wanted in the front end or requested in front end, but that requested timestamp is like nowhere to find on on-chain data. It only if like all these platforms share their data in the backend with us, so that we can measure that. So that could potentially make the auction platform, which has a longer time for the solver to respond, look better, if that makes sense. Like they actually performed worse, but they actually looked better because the longer waiting time. And like if you ask me what would I do use on DEX these days, I will plug in that I still use Matcha, not because I worked at 0x, also just because the sleek UI and UX, but also I wanted to say like still with this research, we don't know how all these solar platforms compare to a DEX aggregator like 0x or like the classic route of 1inch. It's quite hard to compare because all these API nowadays is no longer open source. I mean, because that's the way they make money. It's their, core parts of the business. So there's no like public API endpoint that we can pin and just get a price. Even though there is like API you can pin permissionlessly, it's gonna be a very like indicative quote rather than an actual quote you can get from settling on chain. Because all these API have like two steps basically. Like first time you pin, there's an indicative quote. Get back to the front end, user confirm in the wallet, and they actually get a firm quote. We cannot get those, so it's hard to still compare even to know if how DEX aggregators compare in this list.
Doesn't Matcha also aggregate solver-based models?
Not really officially. I believe they actually have like a transaction. It's called a Matcha Auto, and that is actually a how to say meta transaction module where you don't need to pay gas; they will pay gas for you. I don't think they ever really went far with like a solver list, and I'd let them compete though.
And I guess to answer your second part, which is like what extends to from the application building side. So a little plug on my side, which is like, hey, on the Soretta side, we're trying to build essentially a better DEX, right? A better DEX that hopefully make LP more money, make LP happy, and at the same time, hopefully can also make traders happy. So in our case specifically with Sorella, we're building this protocol called Anstrom on Uniswap v4, and with the help of app-specific sequencing, we can help recapture a lot of this like MEV arbitrage value that has been lost from the LP's hand, and we try to make it back to give it back to LP, and at the same time provide a lot of the benefits that traders already get, like gasless swaps and uniform clearing price and whatnot. So yeah, we're trying to build like a more coherent end-to-end experience for both the LPs and traders to have a hopefully the best execution possible on Sorella's Anstrom protocol. Yeah. And Dex, you wanna also talk? Yeah.
The way I look at this paper is that we kind of saw from the user's perspective, like which solver is the best. But if you flip the side, if you think from the developer's perspective, that if I'm building a DApp, what is the best way to structure my DApp? So call swap structured by running all the batch auction off chain. So it's sort of like they are sequencing their own transaction. And we saw the results. They provide great welfare for the users, and they also make money for themselves, make money for the solvers. So I just think it is a pretty good design choice for dApps to have the ability to sequence their own transaction instead of just purely rely on the block builders. So that's also the reason why we're very semantic there. So developers, maybe they're not necessarily building a DEX, maybe they're building some other dApps, but they can also benefit from the ability to sequence their own users' transaction.
Does your name add credibility to you building in DEXes?
Yes. I mean, I heard that joke many times. I mean, to be honest, I kind of like it. DEX researching DEXes. Yeah.
Yeah. I mean, feels like the perfect place to work for you.
Yep.
Yeah, Dobby, does your name add credibility as a wizard?
Well, I mean, I guess I don't know. I define myself as a house elf, so maybe. What do you think?
Actually, I'm curious. What's the reason behind the house elf? Like, curious.
Oh, I mean that's just who Dobby is in Harry Potter. I just stole that. Yeah.
I see. Okay, that makes sense. Okay.
Yeah.
I didn't make that connection. I was like, okay, cool.
It's purely like nickname based. There's no.
Gotcha.
I mean, I have a house. I live in a house, and
I'm an
elf. I have nothing. I'm an elf as well.
Wow.
Yeah, that's pretty much it.
I see.
But yeah, thanks you guys for coming on, for presenting your research. This has been really interesting. I can't wait to see what you guys build and, see future development happen in public. And hopefully, the DEX space keeps on improving from here. And maybe, who knows, one day it gets, to a place where it's better than central exchanges. It's going to be hard, but who knows? Got to have a good North Star. This has been Index Podcast. Thank you for listening. And bye-bye.
Crypto data wizards, come join us for the parade. From Bitcoin ETF to Solana meme coin trade, uncovering public secrets in the blockchain shade. Bad chiller, cherry picking liar. We call them out and set chart crown on fire.